It's getting worse as the global economy is about to crash. I'm your host, Steve Van Metre, and thanks for joining me today. And some recent economic data shows the global economy is in much worse shape than economists predicted. And to make matters worse, policymakers are shrugging this off, saying there's no way we can have a massive global recession. As you can probably guess, they're about to be wrong. Let's pick today's story up where we start out with Bloomberg, who headlines as city economists call global recession a clear and present danger as the bank sees the world economy growing at 2.9% this year and only 2.6% next year. Economists repeat they see a 50% risk of a world recession, which we should add is pretty darn high. But let's continue on, because that means the global growth will be below trend, with the U.S. and the euro area expected to slip into mild recessions over the next 12 to 18 months. And on balance, our forecast sees the global economy skating through and avoiding a synchronized downturn, economists said. The risk to our forecast looks skewed heavily to the downside. As such, we affirm our 50% recession call articulated. And notably, we keep hearing these two stories over and over again. We're going to have a mild recession, and there's no way this thing's going to be a globally synchronized downturn. But you have to keep in mind, the world as a whole, what did policymakers do? We gave everybody fiscal and monetary stimulus, and now what are they doing? They've withdrawn heavily, and most of that is going away. On top of that, we're in a global economy now. So when things go up together, guess what they do when they go down? That's right, together, and here's the proof. Japan's Purchasing Managers Index manufacturing dropped to 52.2 in July, services down to 51.2. And just to refresh your memory how those numbers work, a 50 is unchanged for the month before. So when you see a 51 or 52, it means it's growing slightly from the month before. And the way I want you to think of these Purchasing Managers indices is like a pendulum that's swinging back and forth. So when it moves to one side, if you imagine a string with a ball, and then as it reaches out toward the end of its momentum, what happens? It slows down and then it swings the other direction. So when we see these indices start to slow down and get close to 50, it's already giving us an indicator that we're about to swing the other direction. And guess what? Well, it wasn't just Japan that was slowing down. It's a bunch of other countries, as German business activity unexpectedly shrank in July. A preliminary reading of Purchasing Managers survey showed on Friday as companies were hit by inflation pressures and supply chain disruptions. The S&P Global's Flash Purchasing Managers Index for services fell to 49.2 in July from June's final reading of 52.4, while its manufacturing index dropped to 49.2 from 52 the previous month. So there you see, this idea of the pendulum, it's got to the extreme end there and now it's starting to swing the other way. But the other thing I want to note here is the services sector as we go through these, because this is really important. What did we hear? What have people have told us is that, hey, this manufacturing is going to slow down. It's okay because people have been cooped up at home for a long time and bought a bunch of stuff, and now they can't wait to get out and spend their money, all this excess money they have, on services. But I want you to be thinking, wait a minute, if that's the case, why did services fall below 50, and it's now entering a mild contraction in Germany as we go through the rest of this data? Look at here, the Flash Composite PMI, which tracks both the manufacturing and services sector, which together account for more than 2/3 of the German economy, which is huge. Their big juggernaut in the Eurozone fell to 48.0, its lowest level in more than 2 years, from 51.3 last month, showing a slight contraction. How about the broad Eurozone? Business activity there unexpectedly contracted. Again, note the surprise in these, and you see as these people are writing these articles this month, due to an accelerating downturn in manufacturing and near stalling of services sector growth as burgeoning costs push consumers to cut back on expenditures. The S&P Global's Flash Composite Purchasing Managers Index, seen as a good gauge of overall economic health, fell to 49.4 in July from 52.0 in June, well below forecast in a poll that predicted a modest dip. And how about this? A reading below 50 indicates a contraction, and July's preliminary estimate was the lowest since February 2021. The Eurozone economy looks set to contract in the third quarter as business activity slipped into decline in July, and forward-looking indicators hint at worse to come in the months ahead. And we looked at one from the U.S. yesterday. If you remember, the Philly Fed new orders is telling us this thing is going to get a lot worse. And yet, when you read these articles and you're seeing these people, like, they're confused. They don't understand. That doesn't make sense sense to them, and yet it's happening right before their eyes. Excluding the pandemic lockdown months, July's contraction is the first signaled by the PMI since June 2013, indicative of the economy contracting at a 0.1% quarterly rate. And inflation in the current season was 8.6% last month, the official data showed. And while the composite output, which is a blend of the manufacturing and services, price index in the PMI survey fell from June 65.3 and remained high at 63.9. On Thursday, the European Central Bank raised interest rates by more than expected, confirming the consensus about runaway inflation now trump growth considerations. And we're going to see more central bank tightening. We're going to see the Fed on Wednesday coming up. They're likely to tighten. And again, this is what's going on. The economy is slowing down because we've withdrawn all this fiscal and monetary stimulus. And what is the problem? Wages are not keeping up with inflation, as we showed and talked about on the show. And now let's turn to the U.S., because here we see U.S. business activity contracted for the first time in nearly 2 years. Wait a second, this wasn't supposed to happen. This happened in July as a sharp slowdown in the services sector. Again, we were told the services sector was going to boom, outweighed continued modest growth in manufacturing, painting a glum picture for an economy stunted by high inflation, rising interest rates, and deteriorating consumer confidence. S&P Global on Friday said its preliminary flash composite PMI output had tumbled far more than expected to 47.5 this month from a final reading of 52.3 in June. And again, we come back to that pendulum. It swung all the way out to the end, and now it's coming back the other direction, and everyone just says, well, this is just going to be a mild recession. This isn't really no big deal. We'll get inflation under control, and it'll all go away. Well, probably not. With the reading below 50 indicating business activity has contracted, it is a development likely to feed into a vocal debate on whether the U.S. economy is back in or near a recession after rebounding sharply from a downturn in early 2020 at the start of the COVID-19 pandemic. And July's fall marked the fourth monthly drop in a row and was largely driven by pronounced weakness in the services sector. And again, this wasn't supposed to happen, which fell to the lowest since May of 2020 at 47 from 52.7 a month earlier. And that was enough to offset relative steadiness in manufacturing, with the group's factory activity index edging down to 52.3 from 52.7, indicating the sector was still growing, but now at its weakest pace since July of 2020. You can practically say the manufacturing sector is about to hit stall speed. And preliminary PMI data for July point to a worrying deterioration in the economy, according to S&P Global, excluding pandemic lockdown months. And keep in mind, this is a comparative point now. Output is falling at a rate not seen since 2009 amid the global financial crisis, and yet they're confused by how this can be happening, and you're seeing it right before your eyes, a global synchronized downturn. And not to leave out our friends in the United Kingdom, a measure of UK growth slowed to a near standstill in July, according to a closely watched survey that suggests darker days lie ahead for the economy. The S&P Global Index of private sector growth fell to 52.8 this month, marginally above stall speed, and that's the worst reading, again, worst reading since the height of the UK lockdown in February 2021, and perilously close to the level 50 that separates expansion from contraction. And so now you're seeing the entire global economy is slowing down. And we looked at the data yesterday. What does that mean for stocks? It means they're likely to go lower at a point when people are piling into them. And what does it mean for interest rates and treasuries? They're likely to head down and down significantly. And that is a big plus for strategies, particularly Portfolio Shield, that hedges with bonds. And that means it has the ability, unlike a lot of other strategies, to recover a bulk of its losses from this year, while other strategies double down and are likely to head lower. I'll put a link up here in the corner and description below, because now let's head over to our chief strategist, Jeff Snyder, in a follow-up from yesterday. And he comments in his daily, which you can sign up for below. There's a link in the description. Limited time. It's free. Next report out on Monday morning at 8:30 a.m. Eastern. He talks about the regional Fed manufacturing, the Philly survey, which we did. But let's look at how he interprets it. He said the Philly Fed regional survey goes back to 1968 and has rarely been as low as it is currently without a recession in the U.S. The huge decline in new orders, as we talked about yesterday, too much inventory, falling demand for goods, has brought that part of the index down to a low almost equal to March or April 2020, the same as April 2009 or October 2008, when the world was in a massive recession. And keep in mind, this is where the data is telling us the economy is going. If these results were outliers, even among the Fed regional surveys, it would be of great concern, but they're not. He says, instead, more than just the low estimates for each headline or new orders, it is the speed at which these declines have occurred and well as when. As the prior segment, if you let yourself consider the possibility of a recession is already struck or might be about to strike, like the jobless claims, this data wouldn't look any different, nor would many current markets. If you want to hear more about what Jeff has to say, sign up again in the link below. You can also get my research and Tracy's shoe charts on the energy sector, because now I want to show you just how confused these policymakers are, and they've got it wrong. As Derby's take, as Fed Bullard says, yield curve signal might not be so ominous. Fed veteran says the yield curve is twisted by the inflation surge and may not be a recession message. Now, what we're talking about is the inversion of yields, and here's based on Thursday's market close. We see 10-year yields at 2.91%, and I want you to understand they're less than 6-month yields. This is what you call not normal. And I want to point out that when you see these inversions, now we're going to look at the 10-year less than 2 years. So we know right now that 10-year yields are less than 2-year yields. And you'll note that every time we see an inversion, shortly or sometime thereafter, a recession occurs. 1, 2, 3, 4, 5, 6. They're not counting this one, although the pandemic probably scared away the recession. And here we are again. But here's somebody on the Fed, on the policymaking decision board of the FOMC, for St. Louis Fed Chief James Bullard. When it comes to current yield curve inversion, it's a case of this time is different. In a virtual appearance last Friday, the central banker said even though yield curve inversions tend to signal recessions, this one probably driven by inflation, a less ominous factor. So this is filed under, he doesn't get it, and he thinks this is no big deal. But it's huge, because I want you to understand that the Fed is tightening into a recession. That's what the curve is telling us. It's saying long-term growth and inflation expectations are coming way down, and the Fed's making a huge policy mistake that's going to lead to a deflationary recession. A yield curve inversion happens when short-term treasury bonds have higher yields than long-dated ones despite carrying lower risk. These inversions have an extremely strong, decades-long history of coming before recessions, though no one can quite say why this is the case. The 6 recessions that have hit the U.S. economy since 1980 have all been preceded by such inversions, so this measure has become something of a talisman to market participants of bad things ahead. In this case, Mr. Bullard said the massive surge in inflation the central bank is trying to counter with an extremely aggressive rate rise campaign is a force that's distorting yields. When it comes to inversions, he says, I take that seriously as a signal and has been accurate in the past, but he says, I think this time is different. And Mr. Bullard said the curve is positioned the way it is because bond traders have priced in a big drop in inflation as a result of aggressive Fed action. We'll just say he's wrong about that. Anyways, I think if the reading of the yield curve inversion is different in the circumstance than it would be if inflation was just at 2% and expected to be at 2%, then we got a yield curve inversion. I would take an inversion as a more serious signal of future recession. Instead, market yields actually reflect some confidence the central bank will eventually lower price pressures. The official said, well, Mr. Bullard, if history has its way, we're headed to a massive recession, and once again, the Fed will tighten into it. Of course, we know what it means when the yield curve inverts. That means rates are coming down, and the long end is set to crash along with inflation and the rest of the economy. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.